Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to talk about to Roth or not to Roth.
Yes. Yes, we are.
And this is going to be the first of a three-part series. So definitely, if you listen to this one, definitely check out the next two. Because after today's conversation, we are going to dive into essentially how to put the dollars into Roth accounts or tax-free accounts. And then the last piece is when to convert and the strategy to convert to Roth, if it makes sense for you and your family.
There are a lot of nuances to this conversation.
Yes. So we're going to keep it as simple as we can. Today's conversation is really maybe the misunderstanding or misconception of, when to Roth. And so we're going to dive into that today. But before we dive in there, Mr. Collins, what are you drinking right now?
I am drinking just a lovely, lovely sour. It's called Temptation. It's from Russian River. Anytime I have a cork in my beer, I know it is going to be really, really good.
Russian River makes good beer. I'll let you talk into the sours. Sours are not my favorite, as I think most of our listeners realize. So I'll let you dive into that. I went to an old favorite of mine. Went down to the Valley House. Haven't been there in a while, actually, and grabbed their Tolt IPA. And so that's what I am drinking right now, Mr. Collins. How's your sour? I would like to see the bitter beer face or the sour beer face. So, anyways.
Delicious.
Not awkward at all. All right. All right, let's talk about to Roth or not to Roth.
Yes, I believe this was originally attributed to Will Shakespeare.
Or Bill, as I know him. So, man, we are corny as hell today.
Dad jokes abound.
So, we get this question a lot is like, when should I Roth? Maybe I'm not, and the question we always get back to is, okay, are you at your highest tax bracket currently? Like, let's just start there. Forget about the whole conversation around tax diversification, which we speak into a ton. Like, when you get to retirement, do we want all of our money sitting in one style of an account from a taxation standpoint? And Alex and I have an opinion of no, we don't want all of it in one account because we don't know what taxes are going to do in the future. We don't. Right? We might have an opinion, but we don't know with any certainty. So for today's conversation, it's going to be about, okay, if we're going to do a Roth, like when do you do the Roth? And this is where it comes down to, our incomes. And before we dive into that, I think it's a great starting point, Alex, and correct me if you don't want to start here. Let's start at looking at the actual tax code.
Yeah, fun stuff. We promise we'll make this easier to digest. So this is Ryan's looking at what the tax brackets look like for a married filing jointly couple. He's plugged in $300,000 of income as just a reference point, and that puts someone solidly in the middle of the 24% marginal tax bracket, and effectively this person's paying right around 20% in taxes at a national level. Doesn't take into account any state level taxes or anything of that nature, just for clarity.
So Alex already brought up marginal, right, and effective tax rate. And I think this is oftentimes misunderstood. Let's real quick define these two tax rates, right? So as we look at the tax brackets here, what's interesting to note is, look, the first $23,850 that this married couple makes is taxed at 10%. You can see the taxes owed is $23,885, which is 10% of $23,850. The next, what is that, Alex? $73,000, and I'm rounding here, is taxed at 12%.
Mm-hmm.
Then the next, what is that, Alex? 110,000 of income is taxed at 22%. The last $94,000 that this couple makes is taxed at 24%. That is the marginal tax rate.
marginal tax rate is if we earn $1 more, what is the rate at which it will be taxed? The answer in this situation is 24.
Now, the effective tax rate is if we take the total taxes, in this case, 57,694, and we divide that by our income, we get our effective tax rate, which, as you can see there, is 19.23%.
And for anybody who's just listening to this, you may want to check out YouTube for this episode, because we are sharing a screen and walking through the actual tax table. It will be certainly helpful to go ahead and have the visual that goes along with Ryan and I yakking at you.
So now that we understand marginal and effective tax rate, so the question that we always bring up with our clients is this. Okay, so the question is when to Roth and when not to Roth. Okay, if you're 35 years old and this is your household income of 300K, is this your lowest tax bracket, or is this your highest tax bracket that you'll be in?
I mean, hopefully it's not the highest.
Right?
Because we want your income to go up.
And here's the other kicker. Again, once we get above 394, whoops, horrible circle there. Once we get to 394, we jump into the 32% tax bracket. That's a big jump, 24 to 32.
Right? Going from 22 to 24, whatever, it's 2%, like whatever the change in tax rates are over the year, likely going to make a bigger difference than that 2%. Going from 24 to 32, that's a much bigger difference.
And so when we look at our overall, like what we normally see, right, if we look at a chart around what our income does, normally our income goes some version of this, right, Alex?
Yeah. I mean, it's not going to be like logarithmic like that. It's not going to be smooth, but yes,
Sure.
It's going to go up, and it's going to go up exponentially.
And if this is the year, maybe this is when we're 35.
Mm-hmm.
Maybe at this point here, or slightly above that, maybe this is our age 55, so 20-year period. Maybe this might be the time where we're finally in maybe our highest tax bracket we'll be in, from the standpoint of our highest income. Because normally once you get into your mid-50s, oftentimes, especially from a salary type position, this is the highest rate of tax we'll be paying in these older years, if you will.
And somewhere in that early to late 50s is where we actually cross over and start paying the same marginal rate as the rate that we're going to have in retirement. Everyone's situation is different. Run the numbers for yourself. Have a conversation with your tax advisor, but ask the question, hey, given what my income has been doing, where are tax brackets going to be? Like, where's my tax bracket going to be? Assuming that there's no changes to like the tax brackets. The tax brackets keep doing what they're doing. My income keeps doing what it's doing. Like, where should I expect to be at retirement?
Yeah, that's a great conversation to have with your CPA, your tax advisor, and your financial planner, right? Because those conversations should go hand in hand. Because, I'm just playing 10-year brackets here, right, Alex? If this is age 45, I don't know. You could still argue that Roth still makes a ton of sense.
Yeah. Like in this situation, like if we're making $300,000 and like, let's say that our income's going up at 5%, like, okay, in 10 years, like our future value of our income might be 488. And at the same time, if that top tax bracket goes up at say 3%, then like we're still going to be inside of that bracket. So we'll still be inside of the 24% bracket. Like we would need a very significant bump in income to get above that tax bracket in 10 years. Now, if we go out 20 years, yeah, we're absolutely going to exceed that 24% bracket, assuming that we have more growth in our income than we have in our tax brackets. The only question becomes, okay, when in that 20-year time period do we start hitting that? We're trying to predict your income. We're trying to predict politics. We're trying to predict way too many things. It's not possible. We can talk about it from a generic standpoint. And the generic standpoint is over the next 10 years, we might bump up. Over the next 20 years, it's likely that we're going to bump up, assuming that we have upward movement in our career.
And the other part of this conversation is what does the rest of your balance sheet look like? Is all of your money already in imagine you're the 55-year-old, right? And there's this thought that we're going to be in a lower tax bracket in retirement. You and I have done plenty of episodes around that. May or may not be true, because oftentimes what we have found is oftentimes you're unless you're going to play like the game of, well, I'm definitely going to be closer to the 394 range when I get to close to retirement. Therefore, I'll be in the 24% tax bracket. Like, unless you're getting that close, it may or may not happen. And to take that a step further, let's just say it did occur. So in theory, here's our income. We only need this amount of income now, right? So we're down here from the income in retirement. So let's just say you went down a tax bracket, and that's if it magically you are on the verge of a different tax bracket to begin with. The question that we often ask is, well, lower than what? So if you're in the 32 and drop to 24, okay, that's one bracket. What if you could actually be, with tax strategy and tax and proper financial planning, what if you could be in the 22% tax bracket marginally? How would you do that? And so this entire conversation around Roth or not to Roth isn't necessarily always around what income level you're in today. It's also what your balance sheet looks like today. Is if all of your money is pre-tax, meaning in a tax-deferred account, you might want some tax diversification there.
You're not going to have a choice in retirement. So much of like building up assets in Roth is, okay, what if we have a really expensive year? Like we've got a bunch of surgeries, or we want to do a bunch of travel, or whatever else the case may be. By having dollars inside of Roth that we can go ahead and pull, like let's say we are magically just below that 394 limit, but we want to take a nice, month-long trip to the Caribbean, or, go see Australia, or what, like do a once in a lifetime type trip. Do we want to pull out more dollars out of traditional and go up and pay 32%? Or might that be better off being pulled out of Roth if all of the rest of our money is going to stay underneath that bracket, whatever that bracket looks like at retirement?
Yeah, solid point. Which really, this kind of takes us to our next part of our conversation here, Alex, and that's around now how do we fund these accounts, right? How do we fund more money into tax-free accounts and create that tax diversification, which is our next episode. So make sure you tune in for that. Look, we started this podcast to hopefully bring some insights around financial planning and look at your balance sheet rather than individual accounts, rather than just focusing on rate of return, because that's not financial planning. Like if you're relying upon the market to make or break you, good luck. Because that's pure timing, and that's just not something you can control. Hopefully we bring some extra stuff to this and have you think differently about your money. So head over to beerandmoney.net, and at the top of the page is a great spot for you to either ask us questions for today's episode, as well as check out other episodes that we've recorded. If you have a question from today, it's also a great spot. Contact us. Great spot to answer, to give us a question. We hope this episode is valuable for you. And as always, Mr. Collins,
cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7727833.1 expiration date March 2027.